Hello, everyone, and thanks for joining us. Happy New Year. I appreciate everybody taking a little bit of time out of their day to think a little bit about IRA real estate investing strategies, and hopefully you'll get some information today that will further your thought process in that regard. And the presentation today is really about generating ideas for you of things that you might not have thought of before, and ways that your IRA can participate in real estate investing that might be beneficial for you, either in the short term or the long term. But the new year is always a good time to gather some information and set new strategies. So we thought we'd start out with some ideas for IRA investing that we've seen and that get talked about a lot. And so hopefully we'll clear up some of the possible misconceptions, or at least make the outlines or the way that these strategies work more clear to you. So feel free to ask questions. There in the questions box on your console, you'll be able to enter questions, and if you'll go ahead and type those in, I'll probably answer them at the end, because perhaps the presentation will answer some as we go. But please feel free to type them in as we go, so that there's no question that we'll get to the whatever inquiry it is that you have. And again, the information today is really, it's for you and for your investment strategy. So please do feel free to ask. Somebody else may have that same question. This webinar is not going to be completely comprehensive, and so there may be things that I gloss over that you need some more detail on. I'm happy to do that and get you the information that you need. All right. Start with our basic disclaimer. So all the information in the presentation today is going to be for education purposes only. At Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular investment strategy or any particular investment vendor. We certainly encourage you to use your financial team and your real estate team when you're vetting any investment that you may be going to choose for your retirement account. And one of the things that I think that disclaimers can sometimes be throwaway, or just, a CYA kind of deal. But one of the things that I think that our disclaimer speaks to about the way that we operate, or our role at Advanta IRA in your IRA investing, is it is important for you to understand that as the owner of the self-directed IRA, that the due diligence and the motive force behind choosing an investment and vetting that investment does lie with the account holder. It doesn't lie with the IRS. It doesn't lie with us as the IRA provider. It really is the IRA holder and their financial team, whether that's your attorney, CPA, family members, whoever it is that is your financial team, perhaps a trusted real estate professional. That decision-making process lies with the account holder. So understand that as the account holder, you're going to be the one that's choosing the investment, negotiating the deal, vetting the investment, and ultimately instructing us to execute it on behalf of your IRA. And at Advanta IRA, our goal is really, as I just said, to kind of help you to execute the investment strategy that you want to put in place. We have a lot of experience on the staff, very long tenured staff. We have a little bit over $1.3 billion of assets that we do the administration for. And our company is really built for personal service. Every account holder gets an education type person like me to do the onboarding, learn about how the account works, how the investment works, things like that. And then you also get a dedicated account manager who's pretty much your back office representative for any kind of nuts and bolts questions about what's going on in your account and things like that, and specifically paperwork and those types of deals. So you get basically a two-person team in Advanta. You have our contact information, email, phone number, all that kind of thing, so you know where to turn to for information and how to make your next move. And so we really like to be able to have that personal connection with our account holders, so that, again, you know where to get information and how to move your account forward. And we also get a sense of, how we can best serve you. And one thing we also mentioned on our slide here is just that all of your IRA's uninvested cash is FDIC insured. We think that's important in terms of the safety and security of your account with us. Do remember, though, that once you invest that cash, the investment itself is not necessarily insured. And when it comes to real estate, obviously you can purchase insurance for that. And so we'll talk about that as we move through the presentation today a little bit. But do understand that your uninvested cash with us is FDIC insured. All right, we'll start a little bit with basics, and then we'll go into more of the strategic thinking type slides. A lot of people have a little bit of uncertainty about what a self-directed IRA is. I think that's largely due to the fact that the term self-directed has been used in a lot of different ways to mean a couple of different things, and so it's gotten a little bit convoluted. So the idea behind a self-directed IRA, the term self-directed, really just means that the account holder is going to have some sort of choice in terms of the assets that the account is going to buy. So a self-directed IRA at a bank or brokerage house like a Schwab or a Fidelity, they might say, hey, we have a self-directed IRA and you can choose from these 10 mutual funds and these 5 stocks or whatever it is. And by virtue of the fact that you as the account holder are making a choice, it is quote unquote self-directed. The term is really, it's a descriptive term. It's not an account type. It's not a legal distinction. It's really just a term to kind of help people understand what's going to happen in their account. Now at Advanta IRA, as opposed to a bank or brokerage house, we actually have a different business model and a different idea about self-directed. Because we do the administration and the bookkeeping and the custody of accounts that purchase alternative assets, that's really what we're talking about. So when we're talking about a self-directed IRA at Advanta, we're talking about combining the tax advantages of the account with the investments that are allowed by law that are essentially outside of Wall Street, so non-publicly traded securities. And you can see a short list of the broad classes there. So there's real estate, all kinds of debt instruments, private placements, private equity, precious metals, cryptocurrency, futures trading, and there are a lot more. The only things that are really prohibited by the IRS are collectibles and life insurance. So that leaves an awfully large array of assets that you can have your IRA invest in and keep the tax benefits. So one of the nice things about it is you get to bring your own expertise. If you know how to make money outside your IRA, more often than not, you can take that same expertise and utilize it inside your IRA and combine it with the tax advantages. So that's really what we're talking about at its core today. And I mentioned that self-directed IRAs are not an account type. The account types are actually the same as the ones that you're familiar with. So there's a traditional and a Roth. SEP IRA and simple IRAs are usually for small companies or self-employed folks in the case of a SEP. Health savings accounts are also able to invest in all kinds of real estate assets. A lot of people are unfamiliar with that. An HSA is not a flex spending account, so it is not use it or lose it, and it operates very much like an IRA, so it's an individual custodial account. Solo 401ks also can invest in these alternative assets, as well as a covered ESA. And I put former employer plans on there because a lot of times when folks decide that they're going to use their tax advantaged accounts to purchase real estate or get into an alternative asset, the way that they get the money over is via rollover or transfer from an existing account. For instance, the most common one is somebody has a 401k at a company for whom they no longer work. And so that 401k plan, all the contributions that have been made there, as well as the earnings, is automatically mobile, meaning they can be rolled over without tax and without penalty. Same goes for an IRA that you have maybe at a bank or brokerage house, whether it's traditional or Roth or any of these account types. Those can be transferred custodian to custodian, again, without tax and without penalty. The IRS will allow you to have multiple accounts going at the same time. It's very common for us to have somebody who has an IRA with us and also has an IRA at a bank or brokerage house, and they are operating both of them simultaneously, and they're doing that for diversification purposes or just where they think the money will make the most money. So keep in mind that the plans that we're talking about are actually the account types that you are familiar with. The contribution rules, the distribution rules, and the tax advantages are what you're familiar with. And the self-directed part, at least when it comes to Advanta, means that you're going to combine those with alternative assets. And I narrowed that down to real estate assets for this slide because we're going to start to narrow our focus here to real estate investment and strategies that go along with that. So, but keep in mind that when somebody says, well, I want to invest in real estate, that's also a pretty broad statement. It can be residential or commercial, it could be a fix and flip, could be a buy and hold, condos, duplexes, multifamily is certainly one that we see more interest in lately. Funds and syndications, again, that can be for a larger property or for something like a REIT that's in a lot of properties. Raw land, trust deeds, any of the financial instruments that are associated with real estate can be part of the way that your IRA invests in real estate as well. So we're combining the tax advantages of those accounts on the previous slide with these assets and the performance that they can yield, because of course one of the tax advantages of those accounts is that the earnings from your investments come back tax deferred, meaning that they can compound faster. Every time you make an earning, it's not being taxed or whittled away, part of it being chipped away. So each time you receive an earning, that can be redeployed in its entirety because of the tax deferred status of the account. So that compounding effect is really one of the main advantages of investing in real estate with your IRA. And it's not that there aren't advantages to investing outside of your IRA, there absolutely are. But once you have contributed money to a tax advantaged account, whether it's a 401k or a 401a, 403b, 457, through savings plan, defined benefit plan, defined contribution plan, after you've gone to the trouble of making contributions to those accounts, I think that one of the things to think about is it then becomes your responsibility to get that money to make the most money. And that's because of that compounding effect, the tax deferred strategy. That's really one of the great powers of these accounts. So once you've made a contribution to those accounts, getting that money to make the most money is a goal that makes a lot of sense. And it works well in concert with the tax advantages. So what we're going to be talking about today is, can your IRA make more money in these real estate type assets than they could maybe on Wall Street? And it could be part of a larger strategy as well with diversification and so on and so forth. But that's really where we are at our core. So now let's start to talk a little bit about the investment strategies and what some of the things that you can take advantage of with IRA real estate investing. So first and foremost, as I mentioned before, your IRA can actually utilize your expertise or the expertise of your financial or real estate team. If you have a real estate professional that you trust that works with investors and investment properties, that's a huge advantage, right? Or if you're a real estate investor yourself, using your strategy or how you're making money as a real estate investor outside your IRA can probably be employed inside your IRA. Now, there are some restrictions, and I'll just mention those right up front because we're not going to get into the nuts and bolts of the rules. But there's a concept for the IRS, which is essentially no self-dealing, and it has in its basic form, it is the IRA holder and certain family members, not all family members, but certain family members, are going to have some restrictions in the way that they interact with the IRA's cash and assets. Things like, my IRA can't buy a property that I already own personally. I can't have my IRA make a loan to me if I'm the IRA holder. Things like that. And we're not going to go into the rules today because we're going to be talking about different types of strategies. But I did put a handout on the console of your GoToWebinar console there. So it's our IRA real estate investing guide, and it does have more information about disqualified persons and prohibited transactions, those things that kind of constitute this concept of self-dealing. So if you want to look into that in a little bit more detail, please go ahead and download that handout, or obviously you can look on our website as well. But going back to our theme here, the idea of being able to take strategies that you have confidence in and use them inside your IRA is really what we're going after here. And hopefully today we'll illuminate a few more of those that you might want to engage or employ in your own financial world. So let's start out with the ownership structures on a very base level. So an IRA can be 100% owner of a physical piece of property, whether that's raw land or an apartment building or self-storage facility, whatever it is. But an IRA, if it has enough money in it, can make a cash purchase, and it is the IRA that owns it. That is one of the ownership structures, and it's a very basic one. The next one is the IRA is also 100% owner on title of a property, whatever that property is, single family residential, duplex, any of those things, but it's using debt leverage. So the IRA, not the IRA holder personally, but the IRA is going to take out debt, and it's going to increase its buying power by using that debt to purchase a property. So if you don't have the full purchase price of a piece of real estate that you want to acquire, you can do that perhaps by using debt leverage. And we'll talk about that in more detail. An IRA can also be a tenant in common with other owners. So again, thinking about the title work, an IRA is X percentage owner alongside other tenants in common. And the possibilities for the other tenants in common are actually quite large, and we'll talk about that again in more detail in the coming slides. But your IRA can participate in a property as a tenant in common with other owners. And then the last one there is on a broad scale is going to be talking about an LLC or other entity. So an IRA can be an equity owner or a debt participant in any number of structures. Sometimes it's an LLC, sometimes it's a partnership, things like that. It cannot be an S corp, but more often than not, somebody's putting together a syndication, whether that is to purchase a multifamily property or an office building, or is going to be in some sort of acquiring several properties and things like that. An IRA can be an equity participant or a debt participant in conjunction with an LLC or other entity that's investing in real estate. So it's another ownership structure. And as a subset of that, I also put in checkbook control, because we're going to talk about that in a little bit of detail. Usually checkbook control is accomplished using an LLC as a subset of your IRA. And then once that LLC, that is the subset of your IRA, in other words, it's using IRA money, once that has been established, it can go out and purchase and sell and participate as a real estate investor in all these ownership structures. So we'll talk about that again in more detail as we go. But as basic ownership structures, these are the things that you're going to own. You're either going to own a thing, or you're going to own equity participation, or you're going to own some kind of debt instrument. So one of those things is going to be the actual structure of the ownership of your IRA, and that's how it's going to receive the earnings, or the vehicle for receiving the earnings. Basics of buying real estate. Remember this, that an IRA is a legal and financial entity, and it is actually separate from your personal finances. It has its own bank account, has its own name, has its own tax ID number, and all those are separate from your personal financial details. The naming convention for most IRAs, and ours as well, is something similar to Advanta IRA. FBO is for benefit of your name, and then the IRA's number is usually good for specificity. So when an IRA purchases a property or a participation in a syndication, or makes a loan, or buys a trust deed or something like that, it is that entity that is making the purchase. And it's very important for the paperwork to reflect that, obviously, because the IRA has different tax status than you do personally. So if the purchaser is in your name personally, the IRS is probably not going to recognize the fact that it's your IRA that's buying that property. So it needs to be in the name of your IRA. An IRA, again, it's its own legal and financial entity. Now you're controlling what happens to it. You can think about it almost as a remote control investor, but it is separate from you, and it has its own operation. And the things that occur in terms of disbursements and receipts of money are these. The IRA, that name with its bank account, is going to pay for the purchase, maintenance, insurance, taxes, capital calls, whatever is required for the asset purchase. That money is going to come from your IRA. But that also means that all the money that is earned, whether that's from rent or proceeds from sale or dividends from a syndication or some sort of fund, all of those come right back into your IRA, tax deferred, and they're ready to be reinvested. So again, thinking about your IRA as a separate legal entity than you personally, but that you are controlling and providing all the strategy and brain power for, is an easy way to kind of think about how it operates. But it is an entity that can go out and buy real estate, sell real estate, invest in all types of real estate assets. Now let's look at using debt a little bit more. I mentioned a couple of things about it in the intro there, but one of the things that's remarkable, I think, about using debt in an IRA, or an IRA using debt to increase its buying power, is that your IRA would actually be making money on money that you never contributed to your IRA. And I'll say that again. So all of the proceeds from the asset that your IRA is going to purchase, and let's just say it's a single family residential home. My IRA has purchased a single family residential with debt, so I'm familiar with it personally, and I am a real estate investor both inside and outside my IRA. So I'm one of us that is doing this type of thing. My IRA didn't have enough money to purchase that property, so I had somebody else help me, basically by securing a loan. So that's really other people's money that came to the deal. At the closing, and I did it about 50-50, I used about 50% IRA money and 50% debt. At the closing, 50% of the purchase price came from my IRA cash position, and 50% came from the lender. And that's the way that I acquired the property. Now, of course, my IRA and your IRA, if it's using debt, as the property progresses, will need to obviously pay the debt service on that loan, just like you would outside your IRA. So again, thinking about your IRA as a functioning real estate investor entity that can use debt, you obviously have to pay that debt back according to the terms of the loan. But the fact of the matter is, the entire rental income is coming back into the IRA, and then the debt service is being paid out of the IRA. So the idea is that you've expanded your buying power with money that you never had to contribute. And that's important, obviously, because all these accounts have some sort of annual contribution limit. So there is a limited amount of money that you can actually put in these accounts. And so this is a way to extend that buying power. One of the things that I always hear in terms of investors who are using this is that they are often considering the cash on cash return. Not everybody is comfortable using debt. And if you're not, that's totally fine. This is not obligatory by any stretch of the imagination. But if you've used debt on other real estate purchases, a lot of times an analysis of what your cash on cash return is may reveal that that property is a great deal, or it may reveal that it's not a good deal. So again, your due diligence is what you're relying on here, but thinking about the effect of the debt on your IRA's money may mean that over the long term, or on a cash on cash basis, that you might be getting a greater yield than you thought you would. Another strategy that I've seen using debt is gaining control of properties when they're hot. And what I mean by that is, I've had investors say, oh my gosh, there's a town that has a neighborhood that is really underpriced right now, and I want to get a hold of as many of those properties as I can. And so obviously the ability for your IRA, if you want to do this in your IRA, the ability of your IRA to use debt means that you might be able to acquire more of those properties and gain control of them right now, while the price is maybe undervalued or is just about to get rehabilitated. The neighborhood has some influx of cash, or any number of things. So I've definitely seen people say, hey, I found a niche here, and I want to get as many of those properties as I can. And so they'll use debt to gain more control of more properties at a single period in time. I will just mention, obviously, that UBIT may occur. So when your IRA is using debt, you again are making money on money that you never contributed. So the net profit that is associated with the debt leverage percentage may be subject to UBIT. So if your IRA is using debt leverage, it is possible that your IRA may need to, as a cost of doing business with other people's money, take some of the profit that's derived from the debt percentage and kick that back to the government, to the IRS. Now, this is your IRA that is paying the unrelated, UBIT is unrelated business income tax. It is your IRA that pays that tax, not you personally. So it is a separate filing for your IRA. It's called a 990T. 990-T, and that is essentially a 1040 for your IRA. And if you are using debt leverage, it's important to think about UBIT if you may have that, and find out what it is. Again, this is all just part of the calculation for the return on investment. And a lot of times, if your IRA investment is performing in such a way that you owe unrelated business income tax, it's doing quite well. So it's not something to be scared of. It's not a penalty, but it is something to think about if you're going to use debt leverage. The other thing that I hear discussions about that I think is a smart one when people are using debt is considering your age and your estimated distribution age. And the reason I say that is this: the threshold age for early withdrawals, the early withdrawal penalty goes away at 59.5, right? So early distribution penalty in both traditional and Roth goes away at 59.5. That doesn't mean that that's when you're going to start to take distributions, but the point is this: I've actually encountered investors in their IRA that will use debt leverage, but they will structure the debt such that when they purchase the property, it's essentially cash flow neutral, meaning that the rent comes in, the IRA pays for the insurance, it pays for the taxes, it pays the debt service, and maybe keeps a little bit of slush fund just in case there's an emergency or something unforeseen, but is essentially operating in a cash flow neutral position. And this is usually somebody who is under 59.5. And the reason that they're doing that is because they don't really need cash coming in necessarily, unless they're really looking to use that cash to fund another purchase. But it may be that the most efficient use of the money is to pay down the debt. And let's just say this, that you time the debt leverage, the debt responsibility, to coincide with when you are going to start to take distributions. So you're paying the debt down relatively aggressively, and let's say that you time it so that the last loan payment is going to be when you're age 60. So the early withdrawal age threshold, you've passed that, and then there's no debt service. So all the rent that comes back into your IRA, it no longer has the debt service. So that means there's a lot of cash that would be sitting there, and you're eligible to make distributions if you want to. So it's very common for me to see IRA holders who set up their rental property to have a periodic distribution, quarterly, semi-annually, sometimes annually. Some people try to do it a little bit more frequently than that, but sometimes that runs into little hiccups. But the idea of having your rental property be producing rental returns that go into your IRA and then putting yourself on a distribution strategy is a relatively common one. Now that can be in a traditional or a Roth, and when it's in a Roth, obviously your distributions, assuming that the account is at least 5 years old, and that means any Roth that you've had that had that money contributed to it. So as long as you're over 59.5 and you've had a Roth open for 5 years, those are qualified distributions. And that means that your IRA literally could have that rental income coming back and then being distributed to you tax-free. So it could just be tax-free income every year until such time as you decided to sell the property. So that's definitely a strategy that I see a lot. But thinking, and going back to our debt discussion, thinking about how aggressively do you pay down the debt and when does it get paid off is something that I also see as part of the equation or the decision-making process. Now, just to be clear about an IRA using debt, because of those self-dealing rules that I talked about earlier, the IRA holder actually cannot pledge their personal assets as collateral for the loan. It's the IRA taking out the loan, not the person. And because of those rules, the IRS will not let me as an IRA holder pledge my personal assets to the loan. So there's two things about that. One is, if my IRA defaults on the loan, the lender can't come back and ask for my personal assets because I never pledged them in service of that loan, right? So if the IRA's loan defaults, the lender has to go to the IRA. Now, the thing that also means is that the lender, understanding this and not going to have a personal guarantee associated with it, at least my personal guarantee as the account holder, it often means that they will ask for 40% down, and that can be plus or minus 10, 15%. but in the median there is probably about 40% down. That's very common. So you may not be able to extend your buying power as broadly or as deeply as you could outside your IRA with maybe 25% down or something like that. But you'd still be able to do it. But understand that because in most cases and most loan documentation, the only collateral that's associated with the IRA's debt is the subject property. That means that if there is default, the lender really can only take that property back. And so usually they want to make sure that that will make them whole. And so it's very common, as I say, to ask for 40% down, give or take, 10, 15%, but 40 is pretty common. And do understand that not all lenders do non-recourse loans to IRAs. And the non-recourse part, that term, is really acknowledging that there is no recourse to the IRA holder's personal assets. That's kind of the I don't know, the place where that term comes from, but it's a non-recourse loan to the IRA holder and disqualified persons. So understand that, when I say the IRA holder, that also includes the other disqualified persons. But that's generally how the loan is structured. Now, one of the other strategies that I've seen that I think is very clever is, let's say your IRA does not have 40% to put down. Your IRA actually can have somebody's personal assets pledged as collateral. It just has to be a non-disqualified person. So disqualified persons are the account holder and their spouse, ascendants and descendants, and the descendant spouses, as well as anybody who's fiduciary to the plan. But usually it's family members. So account holder, parents, grandparents, kids, grandkids, and the kids and grandkids as spouses, as well as the account holder spouse. Those are disqualified persons. That doesn't mean that some non-disqualified person, a friend, or even a sibling or an aunt or a cousin or something like that, those are non-disqualified persons. If they chose to, they could actually be signers on that loan that your IRA takes out. And if they do that, it's certainly possible that the lender will be more comfortable with a lower down payment. So I've definitely seen IRA holders that have secured somebody to pledge their personal collateral or other assets in service of a loan that the IRA is taking that out. It just has to be a non-disqualified person that's participating like that. I've actually even seen an IRA pay a fee to the non-disqualified person to pledge their assets so that they could bring the initial purchase price or the down payment down. So it is possible to change the equation on this non-recourse loan. It's not actually a non-recourse loan anymore. It's just recourse. The lender's recourse is to a non-disqualified person's assets. So do understand that there are some ways to change that equation if need be. Next topic on our outline slide up there a couple of slides ago is partnerships. So let's talk about partnerships a little bit. I mentioned the fact that it can be tenants in common on the title work. And why would somebody do that? Well, there's a couple of reasons. One, obviously, if you don't have the full purchase price, then this is a way to secure the returns on that property, even without having the full purchase price in hand. And what I see in terms of partnerships is that often it is multiple accounts for the same person. Let's say somebody has a traditional and a Roth, and neither of those accounts has the full purchase price. Well, sometimes they'll make them tenants in common on the same property, and they will split it in a percentage basis, cash, dollar for dollar cash percentage. And that means that let's just say it was split 60-40. So every disbursement that's made for purchase, for maintenance, for insurance, for taxes is split 60-40. And all the returns come back 60-40. So each of those accounts is got 60% or 40% undivided interest in that property, is paying for that percentage of the disbursements and is receiving that percentage in return. So that is definitely a possibility. And one of the things that I see more commonly now is health savings accounts participating as a tenant in common. And the reason for that is health savings accounts often have a somewhat smaller dollar value. And that's not to say that I haven't seen 6-digit HSAs. I absolutely have. And HSAs have incredible tax benefits, by the way. So if you haven't looked into it and you have a high deductible health plan, it's something to look at for sure. But if you have an HSA and it has a relatively small cash balance, well, maybe it can be 5% owner, and your traditional IRA could be a 95% owner. So at least there would be returns coming back into that HSA. And one of the cool things about HSAs, of course, is that its earnings essentially are free money, or tax-free money. And in a lot of cases, you need to look it up. The tax advantages are tremendous. But the idea of including that HSA in the earnings of a property is something I see more commonly now. Now, an IRA can also be a tenant in common with other entities like LLCs, or even personal funds, so other people. And hopefully not to confuse this, but the tenants in common can even be disqualified persons. So it could be Clay's traditional IRA as a tenant in common alongside me personally, so Clay personally. So it is possible to have that kind of partnership. Now, the disqualified person rules and the prohibited transactions means that that's pretty rigid. Neither of those entities can buy each other out, and there can't be a whole lot of there can't be any real exchange of cash for position. So once I set that percentage of ownership, it becomes very rigid. But do understand that an IRA can partner alongside other entities, whether that's an IRA, a corporate entity of some sort, or even people, and those people can even be disqualified persons. If it's a non-disqualified person or entity, it's much less rigid. If it's a disqualified person, it's quite rigid. And I'm happy to go into details on that if you're looking into that. Now, the partnership could also be in an LLC or other entity. And there's a few reasons why people do that. One is cash flow management. So instead of having several people on title, or several entities on the title, and having the cash being dispersed from several entities, and presumably the rent also needs to be split into several entities, sometimes those partners will form an LLC or other entity so that the disbursements and the receipts of cash go to a central location. You can also achieve that usually with a property manager. It kind of depends on how you set up the contract with them, but there are ways to handle that cash management. But understand that it's perfectly acceptable for your IRA to be a member of an LLC or partner in another entity, and to have that entity operate the property. Some people use LLCs for the possibility of liability protection. That's something that you would definitely talk to your attorney about, whether that, what level of protection that yields for you. The partnering part, as I mentioned, is often, again, it's a way to kind of clean it up a little bit, or make it a little bit easier in some ways for the logistics. And then we talked about this before, but this is often a very common thing for syndications or funds. So there's an entity formed, and the IRA is purchasing a share in that entity of some sort, and then the entity is out buying and selling real estate, or doing whatever it's doing, operating in the real estate world. So those are all ways that your IRA can partner. Sometimes it's because you don't have the full purchase price. Sometimes you want the proceeds from that investment to go to separate or multiple accounts. But understand that your possibility of investment is there if you so choose. Checkbook control as a subset of the LLC. I'll just touch on this for a second. What is essentially happening in checkbook control is this: an IRA gets set up, it has some cash in the IRA's cash position, an LLC or other entity, but it's vastly more common for it to be an LLC. So the LLC gets set up, the IRA purchases 100% share of that LLC, meaning it sends money to that legal entity. An LLC is also a legal entity. And then the IRA holder names himself the manager of the LLC. And so in one hand, this account holder has a check of IRA money made out to the LLC for purchase of 100% share or equity. And in the other hand, they have the state document saying that they're the manager of an LLC in a certain state. So they go down to the bank and they open a business checking account, and obviously they would be the signer on that checking account. And so the net effect of that, of course, is that the IRA holder is writing checks on IRA money. Now, understand this: the rules follow the money. So setting up checkbook control does not absolve you of any of the IRS's rules about self-dealing or prohibited transactions or things like that. And you also need to just make sure that you do the accounting, because that LLC is going to be an asset of the IRA, so there does need to be an annual valuation of that. But all that being said, the LLC can go out and buy and sell real estate. It can participate in syndications. It can make loans on real estate. Any of those asset participations that we talked about, that LLC can do. And the checkbook control name really comes from the idea that the IRA holder is writing checks on IRA money. But again, does not absolve you of the rules. So if you're going to set this up, obviously make sure that you have access to what the prohibited transactions and disqualified persons rules are so that you don't make a mistake. Now, the other thing, and I put this in the description of the webinar that I'll talk about because it's been a relatively hot topic lately, is Roth conversions. And part of the reason is because I just hear a lot of folks talking about, well, how do I really create tax-free income? And usually that's by having your Roth IRA have investments that are kicking off cash, and that you can actually set yourself up on a distribution schedule for, similar to what we were talking about in terms of the single family rental that has rent coming in, and then the IRA holder sets them up on a distribution schedule. Because it's in a Roth, assuming you're making qualified distributions, that means that those distributions to you would be tax-free. So that's something that I hear a lot, and it's a desire that I think a lot of us have. So there's two ways to be in that position with your Roth. One is to make contributions to it up to the point where you start to purchase the property. The other is to make a conversion. And I think that this is usually more common when it comes to real estate, especially when you're talking about larger dollar values, because often it is an old 401k that you've made contributions to in the past, but you roll it over to Advanta and you roll it over into a traditional, and then you make a traditional to Roth conversion. And what that means is essentially you're taking whatever that amount is and changing it from pre-tax money that you haven't paid taxes on yet, to post-tax money, which is the Roth format. So, of course, traditional is pre-tax money in, tax deferred during the time that it's in the account, the money's in the account, and then it's taxed when you take distribution. Roth flips the script. It's post-tax money in, tax deferred money while it's in the account, and then when you take a qualified distribution, it's tax-free. So essentially what you're doing, and when you're making a conversion, is changing tax strategies. And the way that you do that is by paying the income tax on the conversion amount in the year that you make the conversion. So there's a few things to think about here, and we'll go down the list, but a few things to consider when we're talking about, do you want to be in Roth? Does that work with your overall financial picture? If the answer is yes, how much have you contributed to a Roth? And if it's not enough, why do you consider a conversion, and how does it work? Well, first of all, a lot of the reason why people are considering conversions is because it's possible. The rules changed several years ago, and there are actually no real restrictions on how much you can convert. So it doesn't matter how much money you make when it comes to conversions. Now, if you make too much money, you can't make an annual contribution to a Roth, but that rule does not apply to conversions, switching the money from the traditional IRA format to the Roth IRA format. So there's no income ceiling and there's no amount ceiling. So you can convert as much or as little as you want. It can be a partial, of course. So the ability to do that exists right now. And the reason you would do that presumably is to create tax-free income, either for you or for your heirs. A couple of other strategic reasons that people convert and do this midstream change in the tax advantage is sometimes it's because they expect a large return on an investment in future years. So if it's an investment that you think is a relatively low investment threshold but has the idea to be a huge home run, then it's quite possible that a Roth would be the best strategy from an overall tax burden perspective. I'll give you an example. I had a client who converted some money into a Roth. His Roth IRA bought into an LLC. That LLC was purchasing raw land. It was a land speculation deal. The LLC, the Roth IRA put in $93,000 for its share of the ownership. They went out and bought the land. The LLC did. The LLC bought this land in 2009. 4.5 years later, if you remember what happened in real estate in 2008, 2009, they bought it in 2009. 4.5 years later, the $93,000 that Roth had put in was worth $970,000, and the account holder liquidated it. So that means that all of those earnings, which I think is 877,000 or something like that, it's a lot of math, but that's never going to be taxed because it was in a Roth, right? So if you have an investment that could be a potential home run, it's worth considering, do you want that investment to be in a Roth? Because that may mean that the overall tax burden associated with the entire investment structure is less. So that's one of the strategies that I've seen. A lot of times people will convert to Roth when they're younger, or they're not going to take distributions for a long time. And the reason for that is because there's just more time for the earnings to compound, and therefore, again, the goal of having a total gross taxation of less, which I think is always our goal, can be achieved sometimes by having a Roth that has a long time to operate. Sometimes it's because somebody expects to have a higher tax bracket in the future. The whole premise of traditionals is that you're contributing, presumably in your earning prime, so your income tax rate may be relatively high, but when you're taking distributions, let's say in your 60s, 70s, 80s, your income tax level, because your earnings are lower, may be very low. And so your overall, again, tax burden might be quite low using the traditional. And that's been proven in a lot of studies that actually occurs, as long as the income tax rate that you're operating under when you take distributions is less than the one when you're contributing, right? So that's something to think about. But could the government just change all income tax levels, and could that be enforced when you're taking distributions? Absolutely. Or there could be any number of other eventualities. Now, this is all kind of projecting into the future, so who knows? But if you do, I have seen account holders who have thought, well, I suspect that I'm in a relatively low tax bracket right now in this tax year, so I'm going to convert, because when I take distribution, I might not be in that low a tax bracket. Some people will do conversions to Roth, or even make contributions to Roth when their traditional IRA contribution is not tax deductible. And going back to, and so that's obviously an overall tax strategy, good thing to talk to your CPA about, or your financial team. Sometimes they will, account holders will make a conversion of an asset that is a physical asset, so a piece of property. So let's say the value of a property goes down, but you think later on it's going to go up. Well, if you convert that property in kind, meaning you're not actually selling the property, all you're doing is really converting it from traditional to Roth, that means you would get an appraisal of the property, whatever that value is, and let's say it's a depressed value, then that would be the tax burden that you pay for the conversion. And then let's say 10 years later, that property has skyrocketed. Well, then because it's in a Roth, again, assuming you take a qualified distribution, then you save yourself some taxes. So sometimes the asset itself has a depressed value, and if you think that that's a temporal thing, I've seen account holders convert those assets in kind, because again, the overall tax burden of that investment scenario is going to be less. I've also seen account holders who had a loss on their personal income taxes that they used to offset the tax burden for the conversion, right? So whatever amount you convert is going to go on to your income tax, your 1040 for that tax year, the year of the conversion. And so if you had a loss on another asset or another investment, they may offset themselves. So you may not have to, pull any cash out that you would need to pay the tax on the conversion amount. So again, great idea to talk to your CPA or tax person, whoever your tax team is, when you're thinking about that kind of thing. I certainly see people convert to a Roth for estate planning reasons, so generational wealth. Because Roth IRAs don't have required minimum distributions at 72, that means that the account could keep growing, and then when the account holder dies, their heirs would receive the entire amount. If you're in a traditional IRA, required minimum distributions do start to occur. It's going to be at 72 now, and so at that point you have to start taking distributions. So obviously, logically, you're depleting the account, so there would be less for the beneficiaries to inherit. So if your financial world takes a turn to such that you're really using your IRA as a generational wealth tool, I see it's a relatively common procedure for somebody to convert to a Roth so that they can keep the entire amount growing until such time as they die. And last thing I'll just mention about this is you always do have to have the ability to pay the tax on the conversion. So yes, it's a great idea, but you also have to come up with the cash to be able to pay for the tax burden, because it does not come out of the conversion amount. So it's not withheld from the conversion. Understand that you have to come up with that money. So a few things to think about Roth in terms of your strategy, which assets you're in, and how that's going to work in combination with the tax advantages. And then last big concept before we open up for questions and I wrap up is thinking about distributions. Anytime you're thinking about investments, it's a wise idea to think about, all right, well, what's the end game? How does this end? What's the resolution? So distributions obviously can start without penalty at 59.5. But at some point, if you're in a traditional IRA, you're going to end up with required minimum distributions. At this point, the legislation has changed such that it's going to be at 72 instead of 70.5. But once those required minimum distributions kick in, you do have to start taking distribution of some of the amount each year. It's just a percentage of the overall value each year, starting at 72 and each year thereafter. So understanding that exists can have to do with your strategy, and it comes into play on this next item as well. So when you take a distribution, that can be in cash or in kind. So obviously if your IRA has a cash, let's say rental income, it's very easy to take a distribution of that cash. But you can also take distribution of any physical assets that you have in your IRA. So let's say your traditional IRA owns a piece of property and you wanted to take a distribution of it. It's basically a titling exercise. So you go down to the county, do a quitclaim deed or whatever deed change you deem as most appropriate, and you change the owner from Clay's traditional IRA to Clay personally. And that, in essence, is changing the ownership from my IRA to me personally. Now, in a traditional IRA, I'm on the hook for the appraised value of that property, so I need to be able to handle that. But I can take distribution of the asset without losing control of it. And that comes into another strategy I'm going to talk about in a second. So a couple of things about those two bullet points. One, thinking about what you have in cash and what you have in an asset that is physical or maybe not liquid is an important thing, especially when it comes to required minimum distributions. Now, one of the things that strategies I've seen from a real estate perspective is I've actually seen IRA holders that own physical real estate that will sell that property with owner financing once they know that the required minimum distributions are going to kick in. And what that means is that the returns, the cash proceeds from the sale, are going to come in incrementally to the owner with some, obviously some increased earnings because of the interest rate that they're charging the buyer. So that's one way to change. I'm not going to say convert, to change your physical asset into cash that's readily able to be distributed to you per RMDs, is that owner financing tool. Now, you certainly also can just take the property, have your IRA sell it, and have all cash in the IRA and take incremental distributions. That is obviously a strategy that a lot of people use as well. But thinking about how much cash you have is a good idea when you start to hit that required minimum distributions. Now, that's not to say that you can't do in-kind distributions to satisfy the RMDs. You can, and you can do it incrementally. So let's say in that in-kind distribution scenario I was talking about before, let's say that I couldn't do the tax burden for distributing the entire value in 1 year. Let's say I wanted to do it in 10% chunks over 10 years. I could go down to the county recorder every year for 10 years and change the titling of that property by 10% every year. So first year, 90% owned by my IRA, 10% owned by me personally. Next year, it's 80-20. Next, 70-30. I can do that. Now, I'm going to tell you, it's a logistical hassle. I mean, there's going to be some activity there. So if you wanted to do that, think about the energy it's going to take to do it, but it is possible. So thinking about all those things I think is an important part of your strategy. I already talked about income tax rate now versus when you're taking distributions, so I'm going to pass by that. Buy your retirement home now. This is a strategy I've seen that I think is just really clever way to use the account. And what that means is this. If your IRA has the ability to buy a property that you will later want to retire in, and I've actually seen this occur, it can. Now, while your IRA owns it, there are rules that prohibit you from using it. So the way that it looks is this. My IRA buys a property on the beach, and while my IRA owns it, all of the revenue, it's a rental. So all of the rental revenue comes back into my IRA, and I take that revenue and I keep investing it, and so it's producing returns for me. But at some point in the future, I could distribute that property in kind to myself. And once I've 100% distributed that property to myself out of the IRA and into my personal financial world, the rules about me taking use of it go away. So I actually can go live in it. Now, my IRA purchased it, and while the IRA owned it, I couldn't use it. But once I take distribution, those rules go away. And why is this useful? Well, it's useful in this way. If you know where you want to retire, especially if it's a place where it's hard to find a property that you want and it's available now, your IRA could buy it now. Let's say you're 40 or 50 or 30, maybe you're 25, I don't know. But the idea is that your IRA could buy it now, as long as you don't take use of it while the IRA still owns it, you can distribute it to yourself in kind later, and then the use rules go away. So it's a very clever way to use the cash that's in your IRA to accomplish something that you're going to use later in life and without breaking the rules. Okay. Then we talked about Roth conversion and the reasons to do that. So I think I'll also go past that, and as well as the generational wealth. So thinking about all those things as you get into assets and as you own them, okay, what's the end game? How am I going to get out of this asset in a way that is the most efficient, that fits the rest of my financial world the best? Those are all great considerations when you're thinking about getting into an IRA real estate asset. So I'm going to wrap up and then I'll answer questions. And so one of the things that I'll just make note of is that we do have a lot of educational opportunities. So these webinars we do, we have a video library on YouTube. So our YouTube channel is very robust. The blog on our website is excellent, and it keeps you up to date on new news type of information pieces, the CARES Act, for instance. So anything that's kind of changing in the IRA world, our blog is a great place to look at that, as well as investment strategies and things like that. But please feel free to use our website as a way to find out about events, to increase your education, so that your IRA investing is the most informed that it can be. And if you do choose to make a move this year coming up, and we're in the beginning of a new year, remember that getting started with an IRA to invest in real estate is very easy. You open your account, the application takes about 15 minutes. You do a rollover, transfer, or contribution, or some combination of those things to get some money into your IRA, and then you're ready to start investing. So again, engaging your financial team, your real estate team, and thinking about what assets you think are going to get that tax advantage money to make the most money is a strategy that we see quite often, and it's relatively easy to get started. So if you have any questions about that, please feel free to contact me or visit our website, or any number of other ways to get more education about it. Let's get you started on what you think will be best for you. And one other thing that I'll just mention is we started this event, Pitch, Promote, and Prosper, last year as a way to address the fact that we weren't being able to go to meetings in person or have our lunch and learns in person. So we created a Zoom networking event that occurs every other week called Pitch, Promote, and Prosper. So for you as investors, you're able to come online on a Zoom call, and it's investors as well as investment providers and investment professionals as well. And they all on the Zoom call, everybody gets to introduce themselves. talk about what they're doing, whether it's I'm looking for this type of investment, or an investment provider might say, hey, we provide these types of investments, here's how you can get some more information about that. So it's a way to network in a way that is very specific to, hey, what's my next asset? How can I evaluate assets? How can I get more information about assets? So please do feel free. It's a free event. It's a live Zoom call. It's not recorded, so you do have to be on there. It's every other Friday at noon Eastern time. And you can find the registration on our website. So please do feel free to avail yourself of that resource. And here's my contact information, and I'll just leave that up while we take questions. And if it is time for you to take off for the rest of your day, I realize that we spent the whole hour on the presentation. I really do appreciate you spending some time with us, and hopefully this was helpful. If you do have questions to follow up or to flesh out a strategy that started to occur to you as we were talking, again, please feel free to contact us. We're here for your education. We want you to do this right. So, let us know, call us, send us an email, and we'll give you the information that you need to kind of complete the idea for yourself. And for those who are going to hang around, I'm going to go ahead and take a look at the questions in the question console. And if you have questions that are coming to mind, please feel free to type them in the question box and we will get to them. Okay, can you wholesale a contract proceeds to your Roth IRA? If your IRA purchased the property or controlled the property to begin with, if your Roth IRA controlled the property to begin with, yes, the proceeds from that investment would come back into your Roth. If the question is, can I personally get control of the property and wholesale it and then send the returns to the Roth? Not really. You may have the ability to make an annual contribution in that tax year, but there's no way for your personal finances to invest in something and then just send the proceeds to your Roth, other than the annual contribution stream. Is there a cap on the amount of cash and FDIC insurance? Yes, it's up to the limit. That's a great distinction. I appreciate that. So if your IRA does have cash, it's in a bank, it's FDIC insured, but it is only up to the limit. Does one lose the tax benefits of deductions for real estate when one invests through Advanta in a real estate project in one's Roth IRA? And I think that this question is really asking about the contrast between investing in a real estate asset with your personal funds versus your IRA. Yes, they're different. But keep this in mind when you personally invest in real estate. I take a lot of deductions because I'm trying to mitigate the tax event that's associated with the earnings that I made. But in a Roth or a traditional, those earnings are already tax deferred. So I don't really need to take deductions per se, because I have an automatic tax deferred status on the earnings anyway. Now, that is not to say that there's not a comparison to be made between investing in in real estate in your IRA versus outside your IRA. There absolutely is. But typically what I go back to is, if you have money that's already in a tax advantaged account, the mission is often to get that money to make the most money. And so the question becomes, what asset class do you feel like you're most comfortable in and that will make the most money? And if it's real estate, the comparison of should I invest inside my IRA or outside my IRA becomes a little bit less important, because what you're thinking about is, I have IRA money, I got to get it to make money. But in answer to your question, yes, the tax tools that you would use from a personal real estate investment are different than the tax tools that you would use for your IRA's investment. I just invested personal cash funds in a real estate investment. Is it permissible or not to also invest my SDIRA funds in the very same investment? That's a great question. So this person has invested in a real estate venture with their personal funds, and can they now invest their IRA funds? That depends, is the answer. And the reason it depends is because if your personal interest in the investment is such that you either own or control it already, then your IRA would not be eligible to invest alongside you. If that's not the case, let's say you own 10% and you're not a decision maker for that entity that you just invested in, then absolutely your IRA could be an investor alongside you. The way that the IRS looks at it is, if your IRA is going to invest in an entity, first of all, it has to purchase its participation from a non-disqualified person or entity, so it couldn't buy the shares or the ownership that you already have. And second, are you investing in an entity or a venture that you already own or control personally? And if the answer to those two questions, if the answer to that question is no, then absolutely your IRA could invest alongside. It could be just be another investor. You mentioned needing to have an IRA for 5 years before pulling funds out of it post 59.5. So that's a Roth. That's a Roth rule. So for qualified distribution of all Roth funds, there's 2 rules that need to be satisfied. You need to be at least 59.5, and the Roth has to have been open for at least 5 years. I have just transferred Roth funds from 3 different sources into a new SD IRA. Does the SD IRA need to be 5 years old before I can withdraw the funds? Great question. No. If you have a Roth IRA that you established 5 years ago at your bank or Schwab or Fidelity, and you roll that money over or do a transfer, you've already satisfied the 5-year rule. So there's not a new 5-year clock that starts on money that has been contributed through the regular annual contribution stream. So you would have satisfied the 5-year rule by virtue of having the Roth open at another custodian. That's totally fine. Now, I will say that when you make a conversion from traditional to Roth, the amount that you convert, whatever that dollar amount is, whether it's 10,000 or 100,000 or whatever it is, that amount starts a new 5-year clock for that money. So conversions are different than money that you've contributed. And I know those words start kind of the same, so it's hard. But contributed amounts to a Roth, once that account is open and you start contributing, that starts the 5-year clock for your Roth and all the money that is contributed via the regular annual contribution cycle. And it actually starts on January 1st of the year of the first contribution. Conversions, however, are more varied than that. So it's important to think about the 5-year rule again if you're thinking about a conversion. So I appreciate that question because there is a distinction there. But to finish it up in the last part of the question, it does not need to be the original Roth. So any Roth that you started, even if you then transfer it 5 times to 5 different custodians, once you've started, you've already started the 5-year clock ticking on any amount that's contributed. On the checkbook control, other than the FMV, are there any IRS filing requirements on an annual basis for the LLC? No, not federal. But usually an LLC is going to be state specific, and so usually the LLC has to file documents with the state annually to stay in good standing. But the LLC is essentially acting as a pass-through for tax purposes, and so the fair market valuation of that LLC, that is the quote-unquote checkbook IRA, what you're doing is reporting the annual value back to us as the custodian. We report that to the IRS on a Form 5498. But that's the tax filing. But the LLC itself would not need to file taxes on its operation. If one already owns an LLC which currently holds an account balance, will the IRA be allowed to use the funds in the account to invest in real estate? If I understand the question correctly, it sounds like those are personal funds that are in the LLC. And in most LLCs, if your personal funds are already in there and there are no other owners, typically speaking, the IRA is not going to be able to buy into that LLC because you already personally own and control it. At least that's the way it sounds from the question. So that LLC is going to be out of bounds. So it would have to be a new LLC that is created either for checkbook control, or you could have your personally owned LLC and your IRA be partners in a new LLC that gets formed. So that may have some, you have the ability to do that if that would be a logistical advantage for you. So thinking about that is a great idea. Please confirm that DQ stands for disqualified. Yes, I apologize for the abbreviation. DQ stands for disqualified persons. And so again, that's typically speaking, the account holder, their spouse, parents and grandparents, kids and grandkids, kids and grandkids as spouses, as well as any fiduciary to the plan. Do you still have UBIT if debt is paid off before the property is sold in the IRA? this is a great question. I love this one. So when you are calculating UBIT, the debt percentage, it's only on profit that's attributed to the debt percentage in that year. And so the previous 12 months is very important because that's how the debt percentage is actually calculated. Because clearly if your IRA is paying debt service every month, the debt leverage percentage is changing every month. So the debt percentage is an average of the previous 12 months. So that's how they arrive at that on an ongoing basis. However, the question that's being asked here is there unrelated business income tax that's associated with a property that has paid off the debt? And the answer is, if it paid off the debt 12 full months plus, so I'll say 13, it has to be 12 full months. So let's say your last debt service payment was in December, then that means 12 months later in January, not the January of the coming year, but the next one, that would mean that the IRS would look for the debt percentage. And for 12 full months, 12 complete months, they would look at a debt percentage that's 0. And so if the IRA sells that property, there's no UBIT that's associated with the debt leverage because it's been paid off for 12 complete months plus whatever other time. So, essentially somewhere in the neighborhood of 13 months. So this is a great question, because if your IRA sells a property that has outstanding debt on it or has debt within the previous 12 months, that means that UBIT could occur on some of the profit from that sale. Because again, the IRS is looking at, hey, you're making money on money that you didn't contribute. But if you use that 12-month rule and you pay off the debt service, you pay off the debt, and so you, whatever a week or two starts the next month, and then there are 12 complete months of 0 debt percentage, then when your IRA goes to sell it, there's no UBIT consideration because the previous 12 months debt percentage is 0. So, and then, not to get too deep in the rabbit hole here, but when your IRA is paying UBIT on the profit that has debt percentage associated with it, when you're calculating how much you have to pay, you actually do get to, it's a net profit. It's not the gross income. So let's say your debt percentage is 40%, and let's say that your gross revenues for that property were $10,000 a year. So that means that of that $10,000 that came back to you, 60% of it, $6,000, is not under consideration for UBIT because that's not the debt percentage. The debt percentage is 40%. So $4,000 is under consideration for UBIT, but that's the gross. So you actually get to take, so when you're calculating how much you might have to pay in UBIT, there's a few things that happen. One is you get to take 40% of the depreciation, 40% of the expenses of that property to whittle the gross down to the net. And you also get $1,000 free per year from the IRS, which is not something you hear very often. And I'm making this relatively simple, although, well, I'm trying to anyway. But my point is that you actually do get to use some tools to make sure that the amount of UBIT that you are going to pay is as minimal as it can be. But the really cool thing about what we just talked about in terms of the 12 clear months after the debt is paid off is that, think about your calculation of UBIT for the years when you were paying the debt. You took depreciation every year, right, to whittle that gross down to a net. And so usually when you go to sell that property, you have to account for that depreciation that you took, right, in the overall calculation and the taxes that are due and all that kind of stuff. But because of the quirk of the way that this is calculated with just looking at the previous 12 months, once you're clear of the debt, in other words, the 0 debt percentage for 12 full months, you actually, when your IRA sells that property, it never has to account for the depreciation that it took in the previous years when it was paying UBIT. So it really is, it's a really kind of odd quirk in terms of the way that it's calculated. So I realize that that's a little bit of a a tough thread to follow. But if you want more information about it, you certainly, researching UBIT is an important thing, and thinking about how to deal with UBIT is a good idea as well, because it can change the way you pay taxes. Okay, so that looks like the end of the questions, and I appreciate everybody hanging out here for a little bit of extra time. And I'll hang on the call here for a moment just to see if somebody types in anything else. But if not, and again, if it's time for you to go about the rest of your day, thanks so much for spending some of it with us. And I hope that this information was helpful for you. And happy investing and happy New Year. And again, thanks for joining us today. I really appreciate it. And have a great rest of the day.